A very good evening to my dear MOS members and the ophthalmic fraternity who have joined today. We have the MOS is running a financial series to literacy series for all our MOS and non-MOS members. And it has been interesting that we have a very learned chartered accountant with us. She has been taking webinars for us, and this is the fourth in the series by her. And overall, by the MOS, it is the seventh in the series. So today we have the chartered accountant Arpita Gupta. She is well versed. I mean, everybody is well versed with her because she has taken fantastic webinars on financial literacy. And today also she has come up with a very, very interesting topic. Now, as you know, the Ukraine crisis, Ukraine-Russia crisis is going on. There is a lot of volatility in the market. The markets are going down and still you want to earn. So where do you invest? That is today's topic. With us, we also have a star moderator, Dr. Darshana Gadgil. She is in Mumbai, a very learned and a very humble person, but very well versed with the finance, and that is why she there to moderate today's session with us. We also have Dr. Rajesh Joshi, our honorary secretary of the Maharashtra Ophthalmological Society. So, friends, it's going to be a very interesting session, something to learn about and something to know more when to invest in such uncertain circumstances. So now I hand over for a formal introduction of our speaker to Dr. Darshana Gadgil. Welcome, Dr. Darshana Gadgil and Chartered Accountant Arpita Gupta, ma'am, and Rajesh Joshi to this webinar. And all of you, the August audience, we were waiting with what we say a lot of waiting time. Last month we could not have our webinars because the All India Ophthalmological Society DreamCon was there, and as a state society, we could not hold any conference or webinar 6 weeks prior. So that is why we had to hold back. And today we have come up with a bang, and here we are. So over to you, Darshana, for the
Yes, sir.
formal introduction of our speaker. Welcome, all of you.
Good evening, everybody, senior doctors and colleagues. First and foremost, I would like to appreciate Maharashtra Ophthalmic Society for having such a unique non-ophthalmic webinar series. Thank you, Dr. Taswala, for letting me moderate today's webinar. This being the fourth webinar in the series, most of us have been introduced to CA Ms. Arpita Gupta in the last session where she explained very clearly the mistakes doctors make while they are doing their investments. Now that we have learned our mistakes, we want to learn more from Ms. Arpita about the right investing choices during these uncertain times. Ms. Arpita Gupta is a chartered accountant, CFA L1 from USA. She is the director of niveshmitra.com, a portal for an intelligent way of investing. Ms. Gupta has been a regular columnist to financial dailies like Money Control and has been invited to conduct financial literacy series by Indian Army veterans, top surgeons, IIT and IIM alumni, and corporates like Infosys. I now request Ms. Arpita Gupta to carry forward this session.
Welcome, Arpita, ma'am.
Thank you so much. Thank you for such a warm welcome, and definitely thrilled to be here for the fourth time. Very interesting time actually to do this session. I'll just share my screen to begin with. So lots of volatility in the market currently. Russia-Ukraine crisis happened. Crude oil has hiked to a very, very expensive level for India. And Fed and Indian central banks are continuously taking out liquidity. So in simple jargon-free language for a common man, what is happening is Indian stock markets are having a free fall. And we're all worried if you're invested into or if you're going to invest into stock markets, you're looking at negative returns, or you're looking at your returns or profits being wiped off very, very fast. Every day is really volatile in the stock market. And the second thing update is bank FD rates have started rising finally. PPF rates have started finally rising. So, what are the right investment choices during these uncertain times? There's a lot of uncertainty. US is fighting the fear of having a recession. So what are the right investment choices during these uncertain times? We'll talk about that. To all of you, I'm sure if you attended our previous sessions, you know the drill. If you've not done any of the sessions, so what we basically do is we try to do a 30-40 minute session where I'm going to run you through the presentation, and I've tried to cover all the FAQs or the frequently asked questions that you all maybe have in your mind. So we'll try to cover all of that. We'll make sure that I understand some of you might not be very well versed with financial language, be having a very hectic medical profession. So I've made sure that the presentation or whatever I'm going to talk about is going to be in a simple English language, no financial jargons. But at the end, we'll open for audience Q&A. If you have any question, I'll try my best to take all of the questions. Problems in the current market. Russia-Ukraine crisis happened. Nobody expected that in today's world such thing can actually happen. Rising crude oil prices and commodity prices. Crude has actually risen to almost $110. Today it is $110 a barrel. Why is it important for India? Because we are a major importer. Crude oil is actually very useful for us in terms of transportation, a lot of raw material cost, a lot of, these things are very important. Whatever important manufacturing or anything happens, like any economic activity, crude oil is an important part of that. And India being a major importer, the international crude oil prices really affect us. If they go high, it affects us in a negative way. So that is one important economic update for all of you. Number two, Fed and other central banks are tightening liquidity. In simple words, what does it mean? That is, loans are getting expensive worldwide, internationally, and in India. So US federal government or US federal bank, the central bank of US, and RBI, the Reserve Bank of India, they're basically trying to make loans expensive. They're basically trying to suck out the money liquidity from the system. So money that was really easily available to all of us 2 years back with really low interest rates, that interest rate is actually started to getting up, and there is high inflation. We all, I'm sure, have been observing that pre-COVID and today, if you compare your expenses, your living expenses, your lifestyle expenses, in 2 years, suddenly expenses have suddenly shot up. If you talk about lifestyle expenses, you talk about shopping, you talk about dining expenses, you talk about your grocery bill. When you talk about an economic perspective, the company's manufacturing costs, their production costs, they've all risen drastically. So this is all a major economic update that has happened in India and worldwide. Now, what are the problems being faced by India specifically? We are all living in India, so investment choices available in India are, of course, affected by all of these headwinds and tailwinds. Headwinds is basically the negative factors faced by India currently. Rupee is at an all-time low of INR 78. $1 is 78, which is really, really, rupee has actually depreciated. Dollar has become really expensive. Crude oil is currently at around $110 a barrel. We being a major importer, this basically is increasing our cost of purchase, and therefore there's a pressure on earnings of companies. Companies who are manufacturing. So basically, their raw material cost has increased, inflation has increased, commodity prices have increased, and that has started putting a pressure on their profitability. And number four, FIIs are on a selling spree. FIIs, basically foreign institutional investors in stock market, they are continuously selling in the market. There are two reasons, major reasons why FIIs are selling. Number one is India as a stock market has given an outstanding performance when you compare it with other emerging markets. So as a part of asset reallocation, they are trying to book the profits they've made in India and reinvest it somewhere where the markets have not performed well. Just in a simple language, if a foreign institutional investor is supposed to invest 70% in US markets and maybe 30% in emerging markets, for example, India, if Indian stock markets have given really good returns, the Indian stock market has the holding portfolio of Indian stock market has gone up because of those profits from 30 to 33 maybe. So that 100 rupees allocation from 70-30 has gone to 67-33. So again, they need to, as a rule of rebalancing, they need to sell off that 3% in India, and they need to rebuy anything that is in US or any other emerging markets that have not performed. So that is one of the major reasons FIIs are selling. The second reason that FIIs are selling is because of the central bank. Central Bank of USA has basically started increasing rates. when you when you rise the interest rates of bonds or US Treasury yields, basically it actually, the first effect it has on is the risky assets, so-called stock assets. A lot of money is actually withdrawn from it, and it is parked to risk-free assets like US Treasury bills. So that is why FIs are on selling spree. FIs are continuously selling in stock market. That is also contributing to a volatile and a downward going stock market. But what are the positives? Number one, business conducive government policies like PLI. So PLI is basically a production linked incentive policy, being announced and being worked upon very, very aggressively by the government of India. And that is actually leading to a very good, impact on manufacturing, increasing manufacturing base in India. China Plus One is taking shape. So I don't know if you all know that Shanghai, a very important city in China, is again going through a lockdown because China follows zero COVID policy. They don't want to have any tolerance to COVID cases. And that is why a very big economic center of China, that is Shanghai, they've locked it down again. So when such things happen, economic activity goes down to zero, and a lot of MNC companies have their manufacturing bases also in China. And that is hampering, these China COVID policies, lockdowns are hampering, these MNCs supply chain. And that is why these MNCs are more and more realizing every day that they want to reduce their dependence into China. And that is why they're looking at other manufacturing bases, having manufacturing bases in other emerging markets. And that is benefiting very largely India. And you can actually see, in fact, mobile manufacturing and all of those auto components manufacturing, all of this is actually started benefiting on ground India. A lot of manufacturing facilities, a lot of service facilities have actually started developing or establishing their bases, their extra bases into India to diversify away from China, to reduce their dependence from China. And number three, real estate and IT, a very, very strong recovery. Real estate saw a very big lag in the last 7-8 years. You must have read in the papers, or if you are an investor or you are a buyer or seller, you would have felt that real estate prices suddenly in the last 2 years have shot up. Registration numbers, real estate registries have shot up there at an all-time high. And a lot of it is actually driven by users, end users of real estate rather than investors. And real estate is a very, very important component of the entire Indian GDP. When real estate is actually doing well, it actually helps and gives a very good spillover effect to a lot of ancillary industries. For example, there's home improvement, there's cement, there's labor, there's a lot of manufacturing. So, real estate has a very large impact on India as a GDP. If real estate is doing good, it is going to have a very big spillover effect to India's GDP. Number two, because of COVID, the COVID, pandemic that we faced in the last 2-3 years, companies have increasingly realized the importance of going digital, and their digital plans to go digital or online and all of that has really speeded up. And that is why, if you would have read in papers, IT is seeing a multi-year growth, multi-decadal high growth. So IT companies are seeing huge order inflows, and IT is again a very strong part of the Indian economy. I don't know if you know, but IT's export services is almost now taking care of the entire Indian crude oil import bill. So it is that bigger component of the India's GDP sector. So, these are likely to have really strong spillover effect. Now, when you talk about manufacturing, to understand, how is the manufacturing in India right now, GST collection is a very strong indicator, because everybody who's manufacturing is supposed to, file GST. GST is a very comprehensive tax system that is introduced by PM Modi. So when you see the GST collection numbers, I see the May numbers, they're still at 1.4 lakh crores, which is really, really a good number, which is a very, very positive number. This shows that, India manufacturing, India economic activity is going really strong. The number two indicator, economic activity, is at an all-time high. This is what was pre-COVID activity. And this is, based on a Nomura India Business Resumption Index. If you see, pre-COVID, if we were at 100, currently we are at 125. So our economic activity has definitely increased pre-COVID. This includes your manufacturing, your service, your agriculture, all of these things. And there is a pretty clear improvement pre-COVID to post-COVID in our economic activity. But the biggest problem that we're all facing is Sensex or stock markets. Since the beginning of the year, in fact, since December, it is on a downward roll. It is continuously falling down, and we are currently around -10, -12% year to date. The number one FAQ that we all the time get is bank FD rates have started rising. Should I invest there instead? Stock markets are giving me negative returns. I'd rather protect my capital and invest my money into bank FD right now. When should you go to bank FD in the current markets? Number one, for an emergency corpus. We have strong, if you've seen our previous sessions, we're a strong believer, strong teacher of, creating an emergency corpus. The emergency corpus equal to 6 to 12 months of your monthly living expenses should be ideally parked into a bank FD. This should be, easily accessible without attracting any penalty. So definitely for that kind of an requirement, definitely go to a bank FD. Number two, money you need in less than 1 year. If you want to park your money, you have that money saved for just 1 more year, you need it after 1 year, then park it in bank FD. Don't look at more volatile asset classes. Number three, very, very important, you get sleepless nights on market falls. Today, market fell by 3%. I have a sleepless night. I have anxiety sweats. Bank FD is the best way to invest for you. The reason being, peace of mind is really, really important. Now, my current analysis are in-house analysis of the current bank FD rate. Even if you see a bank FD at 7% per annum, general, SBI, HDFC, they're around giving you 5.5%. Even if you're a senior citizen, they're giving you 6%. If you go to HDFC Limited, Bajaj Finserv, all of these for a corporate FD, you can maybe go to 6.5 to 7%, looking at the time investment horizon. Now, I'm sure all of us here are under the tax bracket of 20% or 30%. Now, if you go for a bank FD at 7%, your in-hand return post-tax is either 5 to 5.5% per annum, not more than that, 5 to 5.5% per annum. We've all discussed in the previous sessions, inflation in India is at least 7 to 8% per annum. You yourself can see your monthly living expenses are actually doubling every 10 years. And you're maintaining the same standard of living. So, inflation in India is around 7 to 8% per annum. Bank FD is still at a negative real return. What do I mean by that? Today, if you park 1 lakh today in a bank FD for 5 years, that 1 lakh will become 1.25 lakhs. But your expenses in 5 years will actually become 1.5 lakhs. So if you're seeing this as at least a guaranteed capital protection, I'm at least getting a guaranteed return. I see it as a guaranteed negative return of 25,000. In my eyes, if you see, you've lost your purchasing power. Today, you were able to buy maybe something worth 1 lakh. After 5 years, you will not be able to buy the same thing. Why? Because your bank FD has not risen by the same rate. You're standing at negative real return. It is just an illusion that you're getting a return of plus 5%, plus 7%. In real terms, if you really want to open your eyes and see, you're actually sitting at a negative return of 1.5 to 2% per annum. But it is just guaranteed. The best part of it is a guaranteed. It's not a guaranteed return. It's a guaranteed loss. I'm definitely not going to lose more than 1.5 to 2% every year. This is what the state of bank FD is. Now, FAQ 2, what is our view on stock market? If I'm saying bank FD is still, not good enough, what is my view on stock market? Stock markets, we need to understand the basic logic behind which stock markets work. In the short term, stock markets are driven by investor sentiments, and that is why there's a lot of volatility. A negative news comes in, stock markets crash. A positive news comes in, stock markets, start a little recovery. So it is a lot of volatility, and you can see the kind of volatility. We went to 61,000 and today we are around 52, 5,500 in Sensex. So a lot of volatility currently in stock market. But the main logic behind which stock markets work is they're directly proportional to the earnings growth of India INC. Now let's see how have been the last 10 years. So basically what this means is the listed companies, all the listed companies in India, the top 500 companies in India, how have their earnings growth, their profit growth in the last 10 years, and what do we expect in the next 10 years, and what are the current valuations like? Let's understand that. Okay, so when you compare last 10 years, the Nifty 50 companies, the top 50 companies of India, their profits have grown by around 2.8 times. The mid-cap companies have become 2.5 times, and small cap companies have become 3 times. So basically, the profitability of the top 500 companies, of the main listed companies of India INC, they've grown to around 2.5 to 3 times. So this is how the last decade has been. Now, the next year, again, we're expecting, and this is including the crude oil impact, that the crude oil is around $110 a barrel. Including all of this, we're assuming, and we're actually predicting through a lot of analysis and in accordance to a recommendation with very big brokerage houses, with a lot of companies, the next 1 year again, we're expecting to see an earnings growth of the Indian listed company at 18%. Now, how do we see that? You need to understand, if you just see the Nifty 50 companies, the top 50 companies of India, at least 50% of the companies are not impacted by increase in crude oil prices. So you look at banking, you look at IT companies, they're all not impacted. They are neutral to rise in crude oil prices. 25% companies are actually benefiting when crude oil prices are rising. For example, Reliance Industries, for example, ONGC kind of stocks. And the remaining 25% are definitely impacted negatively. Now you look at banking stocks. Banking stocks, their profitability in 2018, their entire profit pool went from 50,000 crores to it is currently at 1.5 lakh crores, because a lot of stress from the assets of banks is actually clear now. And again, next year, we are expecting profitability of banking from 1.5 lakh crore to go to 2 lakh crores. So there is a very good revival we see in the banking sector. IT again is going to have a very good earnings growth. So a lot of these real estate factor, capex growth, we see a very good capex growth, and companies are actually expanding their manufacturing capacity. All of this is happening, and this is definitely going to impact. Corporate tax rates have been reduced in 2019. Corporate tax cuts have been undergone in India. That has led to attracting a lot of MNCs, establishing their manufacturing base in India, hence improving India's profitability, impact, and spillover effects again. So next 1 year, we're expecting an 18% growth in the profitability of India INC. Now, if you see, stock markets year to date are at a very bad shape. They are giving you negative returns. You're seeing returns being wiped off every day, or negative return. But if you see equity, flexi cap, mutual funds return, category average, removing any bias, not comparing the top performing or bottom performing, just a category average. Even as on date, the 5-year return of these flexi cap mutual funds is 10.5% per annum, and 7-year return is 11.5% per annum, which is really, really good. If you're looking at bank FD at 5 to 7% per annum in the last 5 years, equity mutual funds have substantially been able to beat those returns, sitting at 10 to 12% per annum, even after this market fall, which is really, really good. Now, that is what I always say, that whenever you're investing into stock markets, your horizon has to be long term. Long term meaning 5 to 7 years. So even if after this market fall, if somebody would have invested 5 years back, he was sitting here today, after seeing this market fall, even then he's sitting at 11 to 12% per annum return, which is really, really good. When you look at valuations, now we saw the profitability, we saw the last 10 years, we saw how the next 10 years are going to be, what are the tailwinds, that are going to be faced by India INC, how are the valuations. Now, when you see the valuations, we see by PE ratio and PB ratio. The PE ratio, we're around average. We are around average of our last 10 years, that is 18.4. So we are not expensive, we are not cheap. When you look at PB ratio, again, we are around average. We are not expensive, we are not cheap. So equity markets are currently fairly valued. Stock markets are fairly valued. At 50 to 500 Sensex, we are fairly valued. We are not cheap, we are not expensive. FAQ 3. Existing investment yielding low or negative return. I'm invested into stocks or mutual funds or passive funds, ETFs. I'm sitting on low returns or negative returns. Number one, you need to understand, make sure you're invested in the right pockets. What do I mean by that? The right pockets. So stock market has 3 pockets. When you talk about market cap wise, there's large cap, mid cap, small cap. Large caps, according to us, are around fairly valued. I'm not saying they're perfectly priced. They're still 5 to 6% expensive, according to me. If you ask me in today's terms, 50 to 500 is still expensive, 5 to 7%. But large caps are still at least fairly valued. But mid and small caps, according to me, are very, very expensive currently. Around they're expensive by at least 15%. So make sure you're invested in the right pocket. If not, try to shift all your investments from mid and small to large cap pockets, because according to me, in this inflationary environment, mid and small caps are actually going to face a very strong hit, and it is better to shield yourself into large caps, which are actually going to be more resilient in this time. Number two question that you need to ask is, since how long are you invested? If you're invested for since 6 months, 1 year, 2 year, 3 year, then this is not the right question to ask. You need to understand investing into stock market, passive, whatever, active funds, nifty bees, or whatever fund that you're investing into, equity mutual funds, you need to stay invested for 5 to 7 years. A category average of equity flexi cap is still giving you, I just showed you, 11 to 12% per annum at current rates, which is really good. We need to learn with history. So we all remember during the COVID market crash, when, on the 21st March 2020, when markets actually fell down by 30%. If somebody who had invested 5 years back exactly on the same date, and in 5 years were ended here, he was sitting at a return of minus 0.3. But if he would have just stayed invested for 2 more years, he would be sitting on 12% per annum return. So, you need to learn with history that, during a market crash, it is the worst time to either withdraw your investments or stop your SIPs. This is the time you need to understand that markets are on sale. If a shop goes on sale, you go and buy more, rather than, thinking that, those clothes must be really not good. Let's stay away from that. You need to understand the entire economic situation of India, and you need to understand that this is the time to actually accumulate units, and this is the first time to withdraw your investments or stop your SIP. So, learn with history. Market crashes are the worst time to withdraw. If you cannot invest further, at least stay invested. If that person would have panicked that, my 5 years have ended and still sitting on minus 0.3% per annum, if you would have just stayed invested for 2 more years, you can see 7 years that holding period came to, and he was sitting on plus 12% per annum. So that is why we don't say exact 5 years or exact 6 years. We always say when you're investing into stock market, 5 to 7 years is the right time horizon to stay invested. If at 5 years there's bad luck, or there's a crash happening, or there's a lot of turbulence in the stock market, just stay invested for 1 or 2 years more. And around 7 years time, there's a very high probability that your returns are in double digit. FAQ4, I'm sitting on cash, where should I invest? This is the fate of someone who invested during COVID crash. Even if he did not invest at the bottom of the market, which is very difficult to figure out what is the bottom of the market. Even if he invested this time, currently he would be sitting, even after the fall, he would be sitting on 54% return in 2 years, which is really good return. So, this is the fate of someone who invested during the COVID crash. He is sitting on fabulous returns still. So crashes, or, these opportunities are basically very good opportunities to actually accumulate more units. My analysis, our in-house analysis of Nivesh Mitra is basically, at least for the next 6 to 9 months, markets are going to be volatile. Markets are going to react on every positive or every negative news. You need to ask this question to yourself. Can you survive minus 10 to minus 20% kind of losses in the short term in your portfolio, and sail through to complete 5 to 7 years of investing time horizon? Can you survive seeing your app, seeing your mutual fund or stock return app, and survive minus 10, minus 20% kind of losses? Because this is how equity or stock markets work. They don't give you plus 12 every year. They'll give you plus 8, then minus 14, and a lot of people lose their patience after 2 years, and they come out with losing their capital and with a bad experience. This is how equity, or stock markets or mutual funds or PMS or small case, this is how they perform, and this is how they give returns. They give a lot of turbulence, but over a period of 5 to 7 years, they will give you a double-digit return per annum basis. So if you can survive these kind of losses in the short term, then definitely go invest in equity mutual funds, small case, PMS, whatever. But no, if you don't have that heart, and be honest to yourself, this is very likely it can actually happen. If you cannot survive it, you will definitely do a panic selling and it can negatively impact your portfolio. So if not, then hybrid mutual funds is the best take for you. Regardless, if you're investing for less than 5 years, if you need that money back in 3-4 years, then equity mutual funds are not the right way for you. Hybrid mutual funds, go for them. What about, SIP or lump sum? I have money, how should I invest? Should I invest at these levels? Is it good enough? If you want to invest via SIP, definitely go for it. SIP is the best friend of market volatility. You don't have to worry every month, because honestly, according to me, next 6 to 9 months are going to be volatile. If you're doing an SIP, that is the best way to actually invest. You don't have to put a lot of brains, and you don't have to have a lot of panic or anxiety attacks if markets go up or down. You're just investing at various levels in the market, which increases your probability of good returns. But if you have lump sum money, buy on dips and whenever Nifty falls below 16,000. So according to me, Nifty below 16,000 is a good level to buy. Currently, we are at a much lower level than 16,000. Now, if you ask me a fair value, I still feel that Nifty 50 or Sensex can still, at least ideally, we're waiting for our clients to at least, we're still sitting on 50-60% of cash, whatever money, extra money, whatever new money we got in January or February. We're still sitting on that money, at least 50 to 60% cash. So I won't say don't buy it at all. Definitely, if you've not bought anything below 16,000, this is the time, invest some amount, but invest 10, 15, 20% on dips. Anything below 16,000 is a good valuation, but according to me, markets, there's still a lot of downfall still remaining. Not a lot. I feel at least in Nifty 50 or large caps, I feel 5 to 7% markets can easily fall down further. So we're waiting personally for that 15,800 to 15,000 Nifty level. If you talk about mid and small cap, I feel you talk about BSE small cap index, we feel 20,000 is the right index level, at least that, then it will get attractive. So I'm currently staying away from mid and small cap, but try to keep investing on dips. Make sure you're investing in the right pockets. About what do I mean by investing in the right pockets? Now, during COVID market crash, markets crashed by 30%. So a lot of people were going out buying HDFC, Nifty 50, or Infosys, TCS, Maruti Suzuki, Asian Paints. So they were basically buying Nifty 50 stocks. What we did was, for our clients, we invested their money into small cap stocks. Now you see the difference of double. The returns given by these blue chip companies is 30%, but the returns given by small cap stocks, which is really attractive, and the odds were in favor of them. We made our clients money invest in those, and we were sitting there, returns were sitting anywhere around 50 to 60%. We've actually booked profits for our clients at 50 to 60% return. So there's a difference of double. So learn from history, make sure you're investing in the right time and in the right pockets. It is the right time. I'm not saying invest your entire money at this level. Spread your investments at various levels. You will get better opportunities also, but don't lose this opportunity just thinking that I'll get better opportunities. These levels are still worth buying for, but make sure you're investing in the right pockets. What are the right pockets right now? Number one, sector leaders. In an inflationary environment, only sector leaders can actually pass on fully or partially margin pressure. I'm sorry, a lot of margin pressure, and you can actually see in these March quarter earnings, a lot of companies are facing margin pressures because of raw material increase, because of transportation cost increase, because of manpower cost increase, all of this. And only sector leaders, somebody who really has a pricing power, only he's able to pass on that increase in price while maintaining his volume. So don't invest in decently good companies. Invest only in the best companies in their sectors. Sector leaders are not necessarily large caps. A lot of sectors have their leaders in mid and small caps also. You should be able to identify the right ones. Number two, financials. We are extremely bullish for financials for the BFSI. The reason being, they're reasonably valued. Improving credit growth. Finally, the credit growth cycle of India is doing a U-turn. It is going up finally. There's increasing profitability. I just mentioned in 2018, the entire profit pool of all the BFSI companies were around 50,000 crores. Today, it is 1.5 lakh crores. And in the next year, financial year 23, we're expecting it to be 1.9 lakh crores. The stressed assets are behind them. Increase in rates is always in general beneficial to financials. Credit growth is being seen. Why? Because number one, a lot of companies are involving themselves into capex, so that is actually leading to credit growth. A lot of stressed assets are behind because a lot of commodity companies have earned in the last 2-3 years because of high commodity prices and all of those reasons. So they've been able to repay the banks, and a lot of bad loans have been either wiped off due to poor profitability, or it has been actually recovered. Number three, capex and real estate allied sectors. I told you in real estate, a lot of end user demand is coming. So home improvement companies, cement companies. So you need to understand which is the right sector related to the real estate allied sector. Then there are companies in the capital goods sector. So building materials, all of these companies we're really bullish on. With this, we can end the session. Just 2 minutes, I'll take, a little brief introduction about myself. As ma'am said, I'm Arpita Gupta. I head NiveshMitra.com. We're a well tech company. I'm a chartered accountant. I'm a CFA L1 from USA. I work as a wealth and investment advisor to clients from varied backgrounds, pan India, and I have a flair for writing. So I regularly write columns for CNBC TV18 owned Money Control for investing and personal finance. A little about our company. So we're basically a well tech company, and we help clients manage their investments and reach their financial goals. So for example, if a client wants to create a passive source of income, or say for their kids' education or general wealth creation, we help them build the right investment portfolio according to their risk profile, according to their risk appetite. And for that, we deal in bonds, debentures, stocks, mutual funds, small case, EIF, PMS, investing in startups. And a niche that our company has developed is a lot of doctors and Indian Army and Air Force veterans. This is the niche that we deal with. Majority of our clients, in fact, 80% of our clients are either doctors or they're Indian Army and Air Force veterans, pan India. So we're a truly well-tech company. We're based in Madhya Pradesh, Indore, but our clients are based pan India. So we're servicing doctors and Army, Air Force veterans across India. So we are servicing clients even in Kerala, Tamil Nadu, Haryana, UP, and this is all been made possible because we are completely paperless and we are a well-tech company. So this is our education initiative by Nivesh Mitra. We have a free WhatsApp newsletter, and we send out articles and financial articles and money tips to help you take better investment decisions and grow your money IQ. So we don't send stock tips, but we send educational articles not more than once a week or once in 2 weeks to actually help you take better decisions with to create your to help with your financial goals, reach your financial goals, or take smarter decisions with your money. How you can join is you can just save this number in your contacts, send *0 to this contact on WhatsApp, and we'll add you to our WhatsApp newsletter. You can either note down this number 9111006340, or you can take a screenshot and you can send us *0 and we'll add you to our WhatsApp newsletter. With this, we can end the session and we can open the floor for audience Q&A. I think the moderators today can help us take audience Q&A. Let's make it an interactive session. And over to you, ma'am.
Absolutely interesting, very nice. As usual, last time also you had done a very good homework and given us a lot of insight into the investment options. And I'm sure a lot of people must have joined your Nivesh Mitra. Can you give us the go-home message of today's talk? The concluding or the summarize the whole thing, just for the audience who have joined late.
Okay, so conclusory remark is basically if you talk about bank FD rates are rising, but even if they're at 7%, they're still giving you a negative real return. Number two, if you talk about stock markets, if you don't want to invest further, but you're worried about your current investments, then hold on, make sure you're investing in the right pocket. Number one. Number two, make sure your time horizon is correct. It has been 5 to 7 years that you've invested. If not, you're panicking too early. Sail through this COVID crash, stop opening your app, and you will actually go out with good returns. Number three, if you want to invest now in stock market, is it the right valuation? According to me, Nifty below 16,000 is a reasonable amount to invest, but markets are still very negative. So I don't recommend investing your entire money right now. Buy at dips, buy 15%, 20%. We feel mid and small caps are still expensive by at least 15 to 20%. They're overvalued. And keep buying on dips and make sure you're investing in the right pockets. Sector leaders, BFSI, capex, and real estate story. These are the three sectors, pockets broadly that we're bullish on.
Perfect. Very nice. How do you find out the sector leaders? What are there any apps where you have an idea of or this sector to find out the sector leaders for investment?
So there are a lot of ways. Sector leader does not just mean that he's selling the highest volume. It should mean that he's able to maintain the margin pressures. He, in case of a bad time, a bad economy, or bad cycle in the business, you can understand or you can figure out that he has had the least volume compression or he has the least margin compression. That is a sector leader. So when you actually read the annual reports, and it is a little hard work, but when you start reading those annual reports, you'll be easily able to figure out that these are the leaders of this company. So for example, in steel tubes, APL Apollo Tube, he's 50% a market leader, 50% market share in that sector. If you talk about pipes, then even if Supreme Industries is having a very high volume, but companies like Prince Pipes or Astral, they have a very good control over margins, and their volume is really is the best when you talk about bad economic cycles. So these are some ways. Yes.
Yeah, you talked about the hybrid mutual funds. What exactly are they, and how do you invest in that? How do you find out which ones are good?
Again, so hybrid mutual funds are basically, if you understand what are they, they're basically an amalgamation of, they'll invest some amount in stock market also, and they will invest some amount in bank FD, corporate FD, RBI bond, all of this also. So they'll give you some fixed income, not in terms of fixed return, but they'll basically cushion your money or cushion your returns to stock market falls. So it is a very good hybrid kind of an opportunity where you're investing in all the 2-3 asset classes. So you're not dependent just on stock market. Now, how do you invest in the best one? There's no best one, honestly. It depends on your requirement. There are a lot of types of hybrid mutual funds. There's conservative hybrid mutual fund, there's balance advantage fund, there's aggressive hybrid mutual fund. You need to understand, you need to align your investing time horizon with the right category, and then understand how has that fund performed in past bear and bull markets. So maybe you can see the rolling returns or understand the portfolio. If in the bonds and debenture side, is the credit quality good enough? So these are some important things that you need to look at.
There are a few questions in the
Yeah,
chat box.
yeah, Darshana.
Okay.
We'll start with the questions. Dr. Jaipal Chopadi is asking in new equipments versus investment in real estate. After mismanagement of economy in the first part of the practice, new second stand up will be what? So probably is asking that if we have the money, should we invest in the equipments for our practice, or should we go for real estate investment, or any other advice that you would give?
So according to me, real estate has also already, reached almost its pinnacle. So real estate prices have risen a lot in the last 2 years, and it is around its pinnacle. Now, either it is a flat line after that, or there is a little degrowth after that. According to me, real estate has already given really good returns. They've already become very expensive. So I'm a strong believer of the thought process that you should not invest into an asset class which has already given you in the past very good returns. Invest in an asset class which is beaten down right now, and that is when you will be able to make money. So according to me, stock markets is beaten down, or I can't comment about your medical practice, to be honest, but real
Right.
estate, it is almost reached its pinnacle. So it has become already expensive. I'm not a strong believer of real estate investment right now, but 2 years back I was open and about saying that real estate is a good investment option right now.
What about sovereign gold bond? Do you advise people to invest, because 2.5% is what it is giving over and above the what we say, the price of the gold? So what do you advise for this?
Okay, so gold, we are generally right now, we have a positive outlook for gold. We are bullish for gold. In what terms? We feel it will definitely give you better the returns than bank FD at least. We expect good returns from gold. Now, the best way to invest in gold is definitely sovereign gold, because
Okay.
they help you generate tax-free returns. over and above 2.5% interest rate.
Correct.
So gold bonds is definitely a good buy. Like it's a
What
good.
about ETFs, gold ETFs?
Gold ETFs is again good, but you won't be able to escape capital gain tax there.
Quite right.
Gold
And
bonds won't be able to escape taxes. You can buy
what
them in
about
the secondary market also.
what about the other commodities, silver, copper, and aluminum? Do you advise to go in for the equity? Now the silver thing is also available as ETF.
So same
Recently
stand
they
for
have
that.
come up.
According to me,
So
gold and
between
silver.
silver and gold, what do you advise? More in silver or more in gold, or both equal 50-50?
I don't study commodities that extensively, and according to me, gold and silver, it's like potatoes. Uh, you can maybe invest 50-50 into it, but not a lot of return difference can be made when you invest into gold
And
versus.
how long you should remain invested in this gold and silver if
And
you
go
advise?
invest through a cycle. Invest through a cycle of at least 5 to 7 years. Gold is again a long-term asset class.
So, of
Quite
the total capital, how much percentage would you advise in gold bonds?
10%. Total 10% of your total investment portfolio, including real estate, including stock market, the bonds, debentures, bank FD, everything, 10%.
Okay.
Your 1 lakh of investment, how would you distribute it now during this uncertain times?
So
Just give an example.
yeah, so currently we're sitting, as I told you, that whatever fresh money that we have got for our clients also, and even of our own family funds, we're still sitting on 50 to 60% cash right now. It's better to
Right.
stay in on cash uh, than invest at, invest fully at this level. We have invested at this level, but I don't want to invest full of my money into this level.
Okay. So out of that, say 1 lakh, you're investing about 30% or 20% at now. In what all different this thing will you invest? And how much percent?
So if I talk about, if I have 100 rupees today, I'm currently sitting on 50% cash. The remaining 50, I would go to, it's majorly gone to sector leaders, banking, and large caps.
Okay.
Mid and small is still not attractive or investable according to me right now. And we've
What about
already booked profits.
corporate FDs?
Corporate
Giving
FDs is again a good option. We discussed this right now. Corporate FDs is the good option. It will give you 0.5 to 1.5% more. Don't go
more
for
than that.
very risky bank corporate FDs, but with low credit rating, just for the greed of that. In inflationary environment, it will be difficult for companies to service very high rates. So be sure of that also, that the credit quality is good. Corporate FDs are a good option, but yeah.
What about crypto? The rates have gone down so much.
We've
Bitcoin
seen
has
the buy
almost fallen
at least
60%,
70%. 70%.
20%. Yeah.
Yes.
So is it the right time to go in for it, or we still wait?
Still wait. Still wait. And I feel crypto market is still very volatile in general. When it was at 61,000, Bitcoin was at 61,000. Still, I had that stand that, cryptocurrency is really volatile. The market, I'm not denying that it should not exist, but it is still in a very immature phase. A lot of developments will still take place in crypto market. So
So
it is going to be very volatile. If you can handle that kind of volatility, please go ahead. But it is going to be extremely volatile.
of your 100 rupees, if you have 50% cash, out of the other 50%, would you advise any percentage in crypto or not at all at the moment?
For a
And when,
very,
if
very
so?
risky investor, for a very, risk lover investor, maximum 5% of your portfolio into crypto.
In crypto. Yeah, Darshana, more questions from you. That's there already.
There are a few on the chat. Mr. Hatem is asking if you could give a perspective of how commodities will act after the Russian-Ukraine engagement is over.
Very strong to very difficult to predict that, honestly. Commodity prices have already gone down because countries like India has also put on export duties, so commodity prices have already gone down. Crude oil prices, ideally, there was one thing that I was reading the other day, that um, after the Russia Ukraine crisis, if you see the total crude oil export in the entire economy, it is already more than what it would have been without Russia, Ukraine. So countries are still taking, they're exporting more, they're producing more. So in those terms, in production terms, there has been no impact. But it's very, honestly, it's very difficult. I'm in no position to predict such things, what will happen to, commodities.
Achha, regarding your Nivesh Mitra, what are your charges for guiding us for the investment? Yeah, have you divided into? I've seen 5 things that you have put it: retirement planning, buying of this, wealth creation. What are your charges? Can you just brief us a little so those who are interested can go in for it?
So we have a very different way of working from other, wealth managers or advisors or mutual fund distributors, whatever you call them. We have a very strong focus on helping the client achieve his financial goals rather than just making the, or creating an investment portfolio and managing it for them. We show a very strong focus to understand what are their actual financial goal requirements. A lot of them cannot be understood by their client themselves. So we try to picture that, we try to convert that all into numbers, and then we help them invest and manage their investment portfolio throughout the investing journey. So if you're investing for 10 years, your goal is 10 years away, we're going to stay with you for those 10 years to make sure, or to try our level best that you achieve that financial goal. Now, in terms of our cost, we don't charge anything from our client directly. We work on a commission of brokerage basis. So for example, if you talk about mutual funds, we work in regular plans, we don't work in direct plans. So for a lot of you, it might think, it might look expensive that, direct plans are much cheaper. But again, we're not, I would, say it on this platform that if you're looking for cheap options, cheap advisory options, we're not the right ones. We provide a lot of value to our clients, and we, ask you to pay also for that, for the kind of value we deliver. So our clients invest in regular mutual funds, and through that we earn a commission of brokerage. So that is why we don't charge anything directly from you. You don't pay anything directly to us, but in the form of commission of brokerage through a regular mutual fund, through a little higher, tad higher, 0.5 to 1% higher expense ratio that you pay in regular mutual funds, that comes to us as a compensation of the service that we deliver to you.
What about stock markets? How much do you charge for that, or you don't? Do you just recommend things wherever you buy the sector leader and all?
So in stock markets, again, it works on, percentage AUM fees.
Sorry?
So, percentage AUM fees. It depends on what kind of money that you're investing, and it is not commission of brokerage wise, but it is on percentage wise. So if you're managing maybe 50 lakhs of your stock portfolio, then we charge X percentage of your stock portfolio.
Okay.
In the form of, yeah.
Fine. There are more questions on the chat box. Darshana, over to you.
Yeah, Ms. Meenakshi is asking what will be the state of real estate in near future?
Yeah, so I have already addressed this question that according to me, real estate prices have already reached the pinnacle. So, I can't predict that it will fall down or anything, but I feel a lot of returns are already behind us when you talk about real estate. They're already very expensive.
So you won't advise the client to put in real estate zero amount out of the 50% cash you said, and the rest of the 50%, none in the real estate, right?
I can't say that. Again, so if you already have money invested into real estate, stay invested maybe. Because what else will you do of that money? So according to your asset allocation, stay invested into real estate. But any fresh money that you want to put, real estate is not the right asset class for fresh money, right?
Okay, fine. That's very nice. I think we have covered majority. Any more questions coming up
No,
in the
no,
chat box? Just check.
no, no.
Yeah,
That's
I
all.
think somebody mentioned about the possibility of stagflation. What do you think about it?
So US is
When mentioned about the possibility of stagflation, I doubt. What do you think? Ali Akbar is asking this.
So I also don't believe that we are close to a stagflation. A lot of growth is stagflation is somewhere, growth, economic growth is not happening. I just showed you through the recent graphs that India is going through a good growth phase. Economic growth is actually happening. It is happening on ground. So I don't see stagflation happening, but there are fears of US battling a recession. US Q1 GDP, January to March GDP growth was negative. And that is a little panicky number. So that is why US stock markets have actually fallen down also. And yeah, I don't see stagflation, honestly. I may be wrong, but I don't believe that stagflation is underway.
In the mid caps, as you said, the large caps, you have the sector leaders. In the mid caps also, you would say okay, you can invest a certain percentage. And can you give some idea of some sector leaders in the mid caps?
I can't take any stock specific names, but mid caps and small caps also have sector leaders. There are a lot of sector leaders in these caps also. So, contrary to popular belief that only large caps are big companies, sector leaders are existing in mid and small cap. If that sector is, according to you, having a good, growth cycle in the next 3 to 5 years, then it is a really good idea to actually, find out its sector leader and invest into it.
What do you see the PE ratio in that, the amount of dividend they are giving, and the growth earnings? What are the criteria you look for in sector leaders when you decide to invest in that?
So sector leaders, again, as I said that, definitely PE ratio is one important factor. One very important factor is understand if the sector is going to do good. Are you positive about the economic or business cycle of that sector? Number two, number three, you will be very easily able to understand that, if January to March quarter, has it been able to maintain its margins than the last quarters? Or has it seen a substantial margin compression now? And there are a lot of earnings analyst calls available for each stock. So, go through that. It might take a little time, but go through that and you'll get a very good idea about the volume maintenance, about
Which
their
are
industry.
the websites they should go in and find out this regarding
A lot of data is
sector?
available. There's available data on Trendline. There's available data on Screener.in. So I personally use these two websites when I'm studying stocks, Trendline and Screener.
Quite right. What about debt-free companies and those who have the promoters the rights more than 50% of holdings? They are better to invest, or
Definitely,
it
we
is
always
again a
prefer
hogwash?
to have companies with promoter investment or promoter shareholding more than 50% and their debt really low. So definitely that is something very important to look at, but these are not the only factors. There
And
has to
cash rich, and the cash more of cash in their hand
not just
to
cash
invest.
rich, but consistently generating positive cash flows, and they are consistently increasing their capacity, or they're continuously reinvesting it into their company. If they're reinvesting that free cash flow into that company, that means they're seeing more potential in their company, that that company will rise further.
What about the solar power companies, the windmill companies? Do they have any future or investment, and the green power that is say?
It is the future,
What is your take
definitely.
on that?
Clean energy is definitely the future. So very bullish about clean energy companies listed in India, listed in international markets. Yes, definitely. Companies working in that area. Yes, they have a very good bright future. Definitely.
What about investment options in international share market?
International stock markets, currently, when you talk about US stock market, we are still not comfortable at these levels also to invest. We want to still wait. But overall, international investment should be a very important portion of your, equity portion. We recommend slowly and gradually increasing your equity investment in international markets to 20 to 30%. Reason being, rupee depreciation really adds to your investment returns.
Okay. And what is the way you take it through mutual funds where they are logged into the international markets, or directly into their stocks?
Uh, both ways, both ways. So mutual fund in
Less risky for people like us who don't follow the markets on a day-to-day
first
basis.
risk is definitely international mutual funds. Mutual funds helping you investing into international funds.
But the returns are less, more in the stocks, direct in the stocks rather than the
In
mutual
India
funds.
also,
Then
if you
you need
look
to
at it
follow.
that way, you can make always more money into stocks, but you can make less returns in mutual funds. It's always that the stocks always will give you better returns, much higher returns, but much bigger volatility and much worse losses if you go wrong. But mutual funds will really balance it out. So it goes the same for Indian and international both markets.
Fine, fine. So, any more questions coming up, Darshana, or we call it a day?
One last question. Would you recommend investing in an LIC policy? And if yes,
Uh,
which plans?
so that is a very, very big answer, honestly.
Hmm.
And I don't know, I think we've covered it in one of the previous sessions that we've done common investment mistakes. If you've not seen, I would strongly recommend you to see it. But just in short, LIC policy, I don't recommend generally because there are a lot of meanings attached to it. Go for a basic life term plan. Don't go for an insurance come investment plan. Now, if you want to understand the meanings and all of that, the logics and everything, go back to our previous session that we've done with Maharashtra Ophthalmological Society, common investment mistakes made by doctors, and I'm sure I think we've covered this.
Yes, yes. We are very well covered in the last to last session.
And this is
I
something
do
really
remember.
important. I'd request all of the doctors, if you've not, if you've not attended that session, very, very strong recommendation. Please go through that because insurance mistake is the biggest mistake that most of the doctors make. So,
Yeah. Regarding the IPOs, what do you recommend? The way the LIC had fallen, people had said go in, and then the opening day itself it had depreciated quite a bit. So, how do you go about in the IPOs? How much of investment you should do in the IPOs? People say on the listing gains you should go in for certain IPOs. What
see,
is
it
your
goes
take on
stock
that?
to stock, honestly. It's very difficult.
Sorry?
It goes stock to stock.
Yeah,
So you
stocks.
can't, yeah, you can't comment on a general that, IPO is good or IPO is not good. It depends stock to stock, number one. Number two, how much can you benefit even from an IPO? IPOs are generally oversubscribed. You can hardly get an allocation. So as it is not a lot of money, you can invest in an IPO.
Quite right. I think we call it a day. Thanks a lot, Dr. CR. I would call you as a Dr. Arpita because you are a doctor in the stocks and investment part. So a big thank you for being part of the MOSCON for the fourth consecutive session that you have been there. The wonderful ideas and investment options you have already given, though there are so uncertain times, but you want people, like the doctors, to make money. So your tips are definitely going to, not the tips, I would say, a lot of educational learning on the financial strategies. People are going to definitely follow suit and of course cover up their losses and of course gain also by wisely investing whatever you have suggested today. Thank you, Darshana. Also, you have done a very good job as a moderator. She's
Thank
first
you.
timer in this. She frankly did tell me, but good way of moderating.
Thank
Dr.
you.
Rajesh Joshi, I would like to have your formal thanks if you are around. Otherwise, we have the 1 minute video of the enrolled people who are giving a strong technical support as usual. We have a gallery view shot before that. Thanks all the viewers who have joined us in large numbers on the Facebook, YouTube, and the web portal. And of course, they are always there. MOSCON is going to continue this literacy series every month with newer people who are going to join us and till the end of my term. And so do enjoy all the investment series and the financial literacy series that we have. Thank you everybody for joining. Thank you Arpita ma'am, Darshana, Dr. Rajesh Joshi and the technical team and all the audience once more. Let's have a gallery view shot and your video please. Yeah, Rajesh, I think Arpita has already left. Anyway,
Okay, sir. Thank you, sir.
nay, Rajesh is there. We'll have a formal
Yeah,
thanks because
uh,
he's always there for the Thanksgiving.
Mhm.
yeah. I really thank on behalf of MOS to Arpita Madam for sparing her valuable time and guiding all of us on this difficult time. where the market is going down and how to invest when the market is going down. Of course, I am very poor in finances. As far as my finances are concerned, they are managed.
I think his internet is a little unsteady.
So, but
Yeah,
since last 4 to 5
हाँ,
4 to
Thoda
5 months, I
internet.
am exposed to new
Yeah.
words like mid cap, stock exchanges, and all. I applaud the initiative.
ठीक है राजेश.
Make me aware of all the. Hello.
Yeah.
Am I
No,
audible?
your net is very unsteady. We can barely hear you. So anyway, the message has gone across. Thank you
Yeah.
very much for everybody for
Thank you.
joining.
Thank you all for.
Yeah. Thanks a lot.
thank you.
And of
Thank
course,
you.
Indor for the
Yeah,
technical
have you
support.
taken a gallery view shot, please? Let's have the video on.
Yes, sir.
And
I
have
have
a-
taken, sir.
You taken, na? Thanks a lot then. Darshana, bye. Take care.
Chalo, bye. Good night.
Bye bye.